Welcome back everyone, and in this video, we're going to discuss the recovery stocks that are expected to have some massive upside as the economy begins to reopen. With multiple vaccines getting distributed across the country and states easing pandemic restrictions, we have seen a shift of investor sentiment. And over the past few weeks, the Nasdaq has dropped 10% as investors seem to be shifting their capital out of big tech that led the market rally in 2020 and are now focusing on the stocks that stand to benefit from further economic reopening. And once we return to normal, consumers are going to be very well prepared. And at this current point in time, we are at one of the highest personal saving rates in history, with above 20%. And going forward, with the potential of another stimulus deal, there is going to be trillions of dollars of excess capital flowing through our economy over the next few months. So in this video, we're going to focus on 4 different recovery plays that come from different industries in the market that have some upside to continue to grow over the long term. And before we jump into company number 1, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And when you think of recovery stocks, there's 2 main categories that these names could fall under. The first one are the brands that are directly tied to the actual reopening of the economy and consumers leaving their individual homes. And those sectors include the airlines, hotels, restaurants, and casinos. And the second category are the companies who are generally tied to the overall recovery of the economy, and that includes the banks, the consumer finance, broad-based apparel, trucking, and many more. So in this video, we're going to go over 4 different companies that fall into those unique categorizations and are going to benefit from further economic reopening that is expected throughout 2021 and into 2022. And if we take a look at company number 1, we have Disney, ticker DIS, currently trading for $190 per share, and the company has seen a mass expansion over the past 12 months, driven by the demand and the growth of the Disney Plus subscription service, which is growing at a record pace. Their current market cap is at $340 billion, and right now, Disney just got some great news that the state of California is going to allow Disneyland to reopen starting April 1st. And before the pandemic, these theme parks all across the world brought in a ton of revenue for Disney each and every year. But over the past 12 months, with them essentially being fully shut down, they have actually been costing the company billions just to maintain. But now they're getting news that they can reopen in California, and I'm sure all across the world as the vaccine continues to get widely spread, we're expecting the reopening of these parks over the next 12 to 24 months. But as this pandemic continued, Disney made one of their best business decisions over the past 50 plus years, and that was the release and the growth of their Disney Plus subscription service. And going forward, I believe this is what's going to drive the company to a much larger level compared to where they are today. And over their latest report, they announced close to 95 million paid subscribers, and by 2024, we're predicting that number to grow to between 230 and 260 million subscribers over the next 3 to 4 years, which is absolutely incredible. And at the end of 2020, across all 3 of their main subscription services, Disney now has close to 150 million paid subscribers, and they're catching up to Netflix, who currently sits at 204 million. And going forward, I do believe that Disney will surpass Netflix and become the leader in the streaming space. And now we're going to take a look at Disney's financials and specifically the balance sheet. Although we're expecting a full economic reopening over the next 1 to 2 years, that still may not happen. There's still a lot of uncertainty on what's going to happen going forward, and we have to be sure that a company's short-term financial position can get them through any uncertainty in the market. So if we take a look, Disney's total current assets come in at $13.8 billion. So a very nice high number compared to their short-term debt that comes in at 26.5. So a current ratio well above 1, so we know at least over the next 12 months, the company's going to have no short-term liquidity issues. And I really do believe with the new Disney Plus subscription generating monthly and consistent revenue, the company's financial position over the next 2 years is going to be very strong. And going forward, analysts have a buy rating on the company with 6 strong buys, 16 buys, and 7 holds, and we can see no one is selling out of Disney at this current point in time. And over the next 2 fiscal years, we're projecting the annual revenue to grow by 5% in 2021, followed by over 31% in 2022. And of course, over the next few months, the parks aren't going to reach full capacity just yet, and we're assuming that over the next 2 years, they're going to get filled up all across the world. Disney Plus is going to continue to grow, and they're actually projecting company's revenue to cross $85 billion. And going forward over the next 5 years, they're projecting 48% per year growth from Disney each and every year going forward. And taking a look, the company is considered a buy, coming in at a 2, and the current share price of $190 sits below the 12-month expectation of $205. So overall, Disney has seen some massive growth over the past year, but with the positive news at the theme parks reopening, the share price has the potential to climb even higher. And now if we move into company number 2, we're going to take a look at Darden Restaurants, ticker DRI. They currently trade for $140 and are up close to 60% over the trailing 12 months. And Darden owns multiple different restaurant chains that are spread out all across the country. And some names include the Olive Garden, Longhorn, Cheddar, and many more. And taking a look, they now operate more than 1,800 restaurants all across the country. And throughout the pandemic, Darden has invested a ton of capital into growing all their restaurant chains, digital technology, and their ecosystem. So right now, they have very well improved ordering online, curbside pickup, and waitlist visibility options for in-person dining. And taking a look going forward, this restaurant got a ton of positive news because as states start to allow indoor dining once again, we're expecting consumer pickup to grow at a massive rate. And like we discussed right at the beginning of the video, consumers are saving more money than ever and are poised to spend it at consumer favorites like the Olive Garden over the next 6 to 12 months. And taking a look at the company's financial statement, before the pandemic, they were growing at a very nice rate year over year. We can see that before 2020, every single year, the company continued to grow their total revenue and it reached a high of $8.5 billion. Then of course, throughout that year, we have seen declines as of late, but hoping that recovery can continue and they can reach record highs. And taking a look at their bottom line, this was a profitable company. Each and every year they were able to grow income following the trend in their revenue with a high of over $700 million. But of course then 2020 hit and they posted a slight net loss of around $52 million. And then in the trailing 12 months, that loss has accelerated now up to $115 million in the red. And although this company has been going through some tough times, Darden is still considered a buy. 30 analysts were surveyed, we have 6 strong buys, 15 buys, and 9 holds. And over the past 6 quarters, even through the global pandemic that almost destroyed the restaurant industry, this company was still able to post better than expected results each and every time. And going forward, in the 2021 fiscal year, analysts are projecting a slight decline in revenue once again, and then a rebound into 2022. And for the next 5 years in the future, analysts are projecting over 34% per year growth, which would be absolutely amazing. And taking a look at Darden Restaurants, they are the company that owns names such as Olive Garden, Longhorn, and Cheddar's, and hopefully as the restaurant industry continues to reopen, the share price can continue to climb to record highs, so do some research into this company going forward. And now if we take a look at company number 3, we're going to go over Berkshire Hathaway, ticker BRK.B, that currently trades for $253 per share. Over the past 12 months, the company has climbed up just above 21%, and their current market cap is at $565 billion, and they trade with a forward PE of 23.19. And this is Warren Buffett's company that isn't really considered a recovery play in most people's eyes. But I personally believe that the names owned by Berkshire fall into the recovery sector. And taking a look, this company right now is actually trading below their estimated fair value of $262 and are sitting at a 5% discount according to Morningstar. So to buy one of the largest and strongest companies in the world with some very diverse operations is definitely an interesting fact at an undervalued mark. And right now, if you're unaware, Berkshire Hathaway solely owns many different companies that fall into the recovery industry, like railroads, insurance, restaurants, and many more. And I think names such as Geico, BNSF Railway, Dairy Queen are going to see some nice benefits going forward. And also, if we take a look at their public equity portfolio, we can see a ton of companies poised to benefit from further economic activity. And specifically, we have names such as Bank of America, American Express, Coca-Cola, US Bancorp, and many more of his smaller holdings. And right now, Berkshire's entire public equity portfolio has a value of $283 billion, which is absolutely insane. And going forward, this is a company that continued to post very strong results even throughout the pandemic. And Berkshire's net income fluctuates with the share price of their underlying public holdings, so that's not the best metric to evaluate the company. Instead, you have to take a look at their cash flow statements, and we can see that year over year, their cash flow from operations is very steady, sitting around $40 billion. So right now we can see that in the trailing 12 months, we actually have a slight increase compared to where they were back in 2019. And with Berkshire Hathaway, what I believe to be their most important financial metric is actually on the balance sheet, and that is this massive cash position of $138 billion. So they have so much capital that they can deploy to do major acquisitions, reinvest back in the business, repurchase their own shares, and buy any public equity that they want. So much cash on hand that can bring in a ton of capital and future expand their business, and we're just waiting for Buffett and Munger to deploy it when they see fit. So right now, Berkshire is a company that when you purchase in, you're getting exposure to many different industries that are all tied in to the recovery of the economy. So I think this is definitely a play to take a look at going forward. And analysts have Berkshire as a buy, one strong buy, one buy, and two holds. And going forward, the company is expected to grow by 23% per year over the next 5 years. And right now, their current share price of $253 sits below the 12-month expectation of $275, and the company currently has a buy rating of a 2.2. So another very interesting company. Buffett is known to be one of the greatest value investors of all time, and I'm sure with that massive cash position he's holding, he's waiting to find a good value for his investors to bring them confidence and great returns over the longer period of time. So definitely take a look at Berkshire. A lot of their underlying businesses are very closely tied to the economy, and hopefully we'll see the share price climb to record highs very soon. And now if we move in to the fourth and final company we're going to discuss today, that is ticker LVS, Las Vegas Sands Corporation. They currently trade for around $62, and over the past 12 months, the company has grown by 13.6%. And they have a current market cap just around $47 billion. This is one of the largest global casino and resort companies on the market right now. And of course, that entire industry was completely shut down because of the pandemic. Travel stopped, casinos were forced to close, but as of late, we have gotten some positive news with reopenings in Las Vegas and in the international front. So as of late, going forward throughout 2021, casinos are lifting their restrictions, are now able to operate at close to full capacity. And Las Vegas Sands is actually primarily focused on growing their international operations in the Asian market, and have actually shifted their focus away from the Las Vegas Strip. And taking a look, they have actually just sold one of their resorts, which is the Venetian, for over $6.25 billion, and actually now focusing on expanding the Asian market. And they got some great positivity because Macau has now lifted their quarantine restrictions and is now back and popping in the Asian front. And from the company's latest quarterly report, we can see a rebound started to come back. Before the pandemic, they were high flying and growing at a terrific rate, but then of course throughout 2020, that took a massive decline. But over the past 2 quarters, we have seen a slight uptick, and although they're nowhere near their previous highs, that growth is looking promising. And one thing that's strong with LVS is that over the next 2 years, they have very little debt that is maturing. Throughout 2021 and 2022, only 2% of their total debt on the balance sheet is coming due, which is a very strong sign. So hopefully by 2023, 2024, the company will be able to operate back at bigger capacity, generate a ton of net income, so they can reduce this debt that has been piling up. And analysts, although casinos have going through some tough time, still consider this company as a buy. 5 strong buys, 4 buys, 7 holds, and once again, no one is selling out of LVS. And for the next 2 years, we're expecting some massive expansion of their total revenue from the record lows that we saw back in 2020, with recoveries of more than 100% each and every year, going back to $8.6 billion in 2021 and then $12.5 billion in 2022. And taking a look over the next 5 years, Yahoo Finance analysts are actually not bullish at all and are actually projecting a decline over the next 5 years. And just for full transparency, I show you the same ratings for every single company. I don't hide this one because it is negative. I like to be fully transparent. And although Yahoo Finance analysts are not bullish, I still think LVS has some room to climb once they continue to expand their full international and Asian operations over the next 3 to 5 years. And although they have bearish expectations, the company is currently considered a buy, coming in at a 2.1. So definitely take a look at LVS if you want exposure to the international casino market. And I think as a whole, once the pandemic is over, consumers all across the world are going to want to travel and visit the casinos and the resorts that LVS owns. So overall, the recovery sector has seen some nice uptick as of late, but analysts are predicting future growth to continue to allow these companies to climb to record highs. So we took a look at a bunch of different brands. We saw Disney in the entertainment space, Darden in the restaurant space, LVS focused on casinos, and Berkshire, a company that owns a bunch of different brands that will benefit from the overall reopening and growth of the entire economy, such as the different smaller restaurant brands, the industrials, and of course, the insurance companies. So as a whole, 4 different companies, they have seen some growth as of late, but all of these names are poised to continue to grow as the economy begins to reopen, and hopefully we can get the pandemic under control and our lives can return to normal. So thank you for watching to the end. I am the Gen Z Investor. I appreciate the support. Please hit that like button and subscribe, and I will see you in tomorrow's video.